Hi, my name is George and I am the principal of Stallion Accountancy Services, and today I will be telling you about the benefits of cash counting for VAT. To begin with, we'll have a look at the traditional invoice basis for VAT, and this is when VAT due is calculated based on the sales invoices issued and the purchase invoices received in a particular period. And under this method, you add up the VAT on all the sales invoices raised in the period. You also add up the VAT on all the purchase invoices received in the period. And as you can see, you take number 2 away from number 1, and that gives you the VAT liability that is due. Example of this, let's say in a particular VAT period you raised sales invoices of £10,000 plus VAT. Well, the VAT on the sales, or the output VAT as it is called, will be 20% of the £10,000 of the net invoices raised, which is £2,000. By the same token, if you assume that you made purchases of £4,000 plus VAT in the period, assuming all the purchases are standard rated, the VAT on the purchases will be 20% of the 4,000, which is 800. So the VAT due will be the £2,000 output VAT less the £800 input VAT, which will give a VAT liability on the invoice basis of £1,200. Now, the problem with the invoice basis for VAT is that the VAT liability will have to be paid to the revenue whether or not your customers have actually paid you the money for the sales invoices. And if they haven't, then this can cause cash flow problems, especially if a large number of customers do not pay, or indeed if you have a large number of sales invoices raised in that period, again, which the customers haven't paid. One little tip is to try not to raise large sales invoices near the end of a VAT period, because if you do this and the customer doesn't pay, then you will still have to account for the VAT on the sales invoices, even though you haven't actually received the money. So under the cash basis for VAT, the principle here is that the VAT due is calculated based on the sales invoices paid by your customers, and also the purchase invoices paid by yourself. So you add up the VAT on all the sales invoices paid by your customer in the period, and you also add up the VAT on all the purchase invoices which you have paid in the period, and you take figure 2 away from figure 1 to calculate the VAT due. So again, looking at an example, again, if you assume that you raise £10,000 plus VAT on your sales invoices in the period, and let's assume that your customers have paid 5,000 of these. Well, in the cash basis, the VAT due will be 20% of the amount due, which is the 5,000. So your output VAT on your sales will only be 1,000. Again, using the purchase example, let's assume that you make purchases of £4,000 plus VAT in the period, but you only actually pay 2,000 of these. Well, the input VAT on your purchases will be 20% of the 2,000 paid, which will be input VAT of £400. So in this particular example, the VAT due will be 1,000 less the 400, which is only £600, which is significantly less than the example, the same example, which was calculated on an invoice basis. So the advantage of using the cash basis for VAT is that the VAT is only calculated on sales invoices that the customers have actually paid, so your cash flow situation should improve. And obviously the bad debt relief is automatic, because if the customer hasn't paid an invoice, then you don't have to account for the VAT on that invoice. Eligibility for the scheme. The estimated VAT taxable turnover for the next 12 months must be under £1.35 million. But you can't use the scheme if you're using the VAT flat rate scheme. If you're not up to date with your VAT returns or your payments, or if you have committed a VAT offence, such as VAT evasion, within the last 12 months. You must leave the scheme if your taxable turnover for a particular year is more than £1.6 million. You must join the scheme at the start of a VAT period, and you must leave the scheme at the end of a VAT period, but you do not actually have to tell the revenue when you are joining or leaving the scheme.